Hello and welcome to the Commodities Institute podcast. I am your host, Emily Costa. It is Tuesday, March 24th, 26. And if you have been watching the tickers today, you know we are living through a period of historic volatility. With over 20 years in this field, I have seen my share of market shocks, from the 2008 crash to the 2022 invasion of Ukraine. But the current conflict in the Middle East is rewriting the playbook in real time. Today, we are going to peel back the layers of how the war between the United States, Israel, and Iran is rippling through everything from the gold in your portfolio to the sugar in your kitchen. Let us start today's analysis in the metals market, which is behaving in a way that might seem counterintuitive to some. Usually, when war breaks out, gold is the ultimate safe haven. However, since the hostilities began on February 28th, spot gold has actually dropped 15%. We saw it touch a 4-month low of $4,098 an ounce early Monday. You might be wondering why gold isn't soaring. The reality is that in the early stages of extreme global shocks, liquidity needs often outweigh safe haven demand. Investors are selling off gold to cover losses elsewhere, or simply to raise cash as they cut risk across the board. Furthermore, with energy prices driving inflation fears, there is a growing bet that interest rates will stay higher for longer, which makes gold a non-interest-bearing asset less attractive in the short term. On the other hand, copper is showing a different kind of resilience. Kathleen Quirk, the Chief Executive Officer of Freeport-McMoRan, noted at the CERAWeek conference in Houston that while the market is jittery, the underlying demand for copper remains secular. Think about it. Even in a war, the world isn't stopping its transition toward electrification or its obsession with artificial intelligence. Data centers and computer servers are gobbling up copper at an incredible rate. Despite prices for the red metal dropping nearly 10% recently, companies like Freeport are moving forward with massive projects like a $7.5 billion expansion of the El Abra mine in Chile. It is a fascinating tug-of-war between immediate geopolitical panic and long-term technological necessity. Moving from the ground to the grid, the war is dealing a much harder blow to natural gas than to oil. We often group them together, but the global gas supply chain is far more fragile. When missiles hit infrastructure or shipping lanes like the Strait of Hormuz close, oil can often be rerouted or drawn from land-based tanks. Natural gas does not have that luxury. It is harder to store and requires complex liquefaction plants that take years to repair. In Qatar, the world's second-largest liquefied natural gas exporter, Iranian attacks have knocked out 17% of export capacity. This is expected to take up to 5 years to fix. This is a massive blow to the global energy transition. While emerging economies were supposed to shift from coal to gas, many, like India, are now pivoting back toward coal and renewables because gas has become too expensive and unreliable. Meanwhile, investors are rushing into Chinese renewable stocks. The logic is simple. The more erratic and oil-dependent the West appears, the more countries will look toward energy security through solar, wind, and electric vehicles, sectors that China currently dominates. We have seen companies like GCL Energy Technology surge 48% this month alone. It is a clear sign that while the US might be doubling down on traditional energy during this conflict, the rest of the world is viewing this crisis as the ultimate advertisement for getting off fossil fuels entirely. Turning our attention to agriculture, the ripples of the conflict are being felt on the dinner table. In India, sugar mills are rushing to lock in export deals. Why? Because the Indian rupee has slumped to a record low while global sugar prices are rallying. This rally is partly fueled by the war's impact on energy, as high oil prices lead countries like Brazil to divert more sugarcane to ethanol production rather than food. This has opened a window for Indian sugar to reach markets in Africa and South Asia. However, it is not all smooth sailing. Logistical bottlenecks and rising freight rates are making it difficult to actually move the goods. Over in Europe, the outlook for the 2026 harvest is looking a bit somber. The crop monitoring service Mars is forecasting a 5% drop in soft wheat yields and a 10% drop in winter barley compared to last year. While the late winter temperatures were mild, excessive rainfall and frost episodes in places like Poland and Ukraine have caused local damage. It is a reminder that while we focus on the geopolitical storms, the literal weather remains a primary driver of commodity stability. Of course, we have to talk about the heart of the crisis: oil. At the CERAWeek conference in Houston, there was a palpable tension between government officials and industry titans. U.S. Energy Secretary Chris Wright tried to downplay the crisis, suggesting that oil prices haven't climbed high enough to hurt demand yet. But the executives on the ground aren't buying it. The chief executive officer of Total Energies, Patrick Pouyanné, warned that the damage goes far beyond high gas prices. He pointed out that the closure of the Strait of Hormuz is disrupting shipments of helium, which is essential for semiconductors and medical supplies. Brent crude is hovering around $99 a barrel, and while President Trump has mentioned talks with Iranian officials, the market remains on edge. The United States has already released a record 172 million barrels from its strategic petroleum reserve, but as Japan's Vice Minister for International Affairs noted, even these massive releases haven't been enough to calm the markets. The reality is that 1/5 of the world's oil and gas supply transits through that narrow strait, and there is no quick fix for its closure. India, the world's third largest oil consumer, is in a particularly tight spot. They haven't bought Iranian crude since 2019 due to US pressure, but the current disruption has forced a change. Washington has issued a temporary 30-day sanctions waiver, and now traders are offering Iranian oil to Indian refiners at a premium of $6 to $8 over Brent. Is a sign of how desperate the situation has become when a country is paying a premium for oil from a sanctioned nation just to keep the lights on and the kitchens running. Finally, let's look at dry freight and the shipping challenges emerging from South America and Russia. Brazil's soybean exports have fallen 18% this month. Part of that is due to the risks in the Persian Gulf. But there are also local hurdles, like China requesting new inspection changes for phytosanitary certificates. It is a double whammy for Brazilian farmers who are currently harvesting a record crop but can't seem to get it to market efficiently. Conversely, Russia is seeing its wheat export prices remain high. Analysts have actually raised their forecasts for Russian shipments, which could reach over 4 million tons this month. As the world worries about the Middle East, Russia is positioning itself to fill the gaps in the global grain trade, further shifting the balance of power in the commodities world. The common thread through all these stories is a world trying to adapt to a sudden, violent shift in the status quo. Whether it is a tech company in Phoenix looking for copper, or a family in Mumbai looking for cooking gas, the events in the Strait of Hormuz are hitting home. We are seeing a massive acceleration of trends that were already in motion: the rise of renewables, the fragility of global supply chains, and the shifting of geopolitical alliances. That brings us to the end of our deep dive for today. The commodities market is never just about numbers on a screen. It is about the movement of the essential resources that power our lives. And right now, those movements are more complicated than ever. Thank you for joining me for this analytical look at the state of the industry. If you found this episode valuable, be sure to subscribe, share, and leave a review. I'm Emily Costa, and this has been the Commodities Institute podcast.